Increases. Good afternoon, everyone. Thanks for joining us today for our final quarterly review of 2025 and our 2026 Market Outlook webcast. My name is Mike Musio. I'm the president of FBB Capital Partners, and I'm joined today by my colleague Mike Bailey, who's our director of research and also the chair of our investment committee. And working behind the scenes, as always, is our teammate Katie Bogley. Today we will review 2025. We'll look ahead to 2026. We'll have some prepared comments, and then we'll have an opportunity for some Q&A that will address both previously submitted questions, of which there are probably a dozen or so, along with Q&A that we have that you all submit during the call. So a couple of housekeeping items as we get started here. You'll note that while you can see and hear us, this is a Zoom webcast, so attendees are going to remain in anonymous view only mode. However, as I said, we expect and are eager to answer your questions as they come up. So look at the bottom of your Zoom screen right now, and in the middle you should see a Q&A button where you can actually type in, submit your questions as they come up. If I can take them on the fly and it's pertinent to the slide that we're on during the prepared comments, we'll do that. Otherwise, we'll aggregate them in the end and we'll get to them. To the extent that some questions are similar, I'm going to try to, in the interest of time, try to get to all of them. I'll try to combine similar questions. Some of the questions we will answer in the commentary itself as well on the front end. Finally, we will be recording the call today, which you heard there at the top. So it's going to be posted for replay on the website probably tomorrow. Yeah, and so as we begin the discussion, let me remind you the fact that the commentary today is based on the facts as we see them right now. Of course, the facts, especially in 2025, are ever changing. Please note that any reproduction or transcription of statements made during the call without our prior approval is prohibited. Should you know someone who you think would like to listen in, you can direct them to the website. As I said, that should be up there tomorrow. Finally, please note that all forward-looking statements made during our call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and the assumptions we discussed today. And we'll give you a chance to review the complete compliance statement disclaimer at the end of the call when we wrap it up. So with that, Mike, I will turn it over to you.
Sounds great. Thanks, Mike. Today we'll be touching on some frequently asked questions that we're hearing, specifically on artificial intelligence and whether there's more upside or if we're in a bubble. We'll also discuss scenarios for the economy, where it's headed in terms of steady economic growth or possibly a recession. We'll then turn to our positioning and then wrap up with your questions. Next slide, please. Okay, so before we dive into one of our main topics for today, let's turn to our first audience poll question and get your sense of what's next in the AI wave. Mike?
Yeah, so very simple. As Mike said, we kind of pulled this together based on questions we're getting most frequently from clients right now. And I think what's people are seeing both online and in print is what's happening within the AI complex. So simple yes or no based on our unofficial poll here, but with a sample size of 40 or so participants. Do you think AI stocks are in a bubble? A is yes, B is no. Please check the box you agree most with, and we'll go from there. All right, Katie, how are we doing? All right, 58% say yes, 42% say no. I'm going to round, so we're 60-40 here, Mike.
All right, very good. So 60-40. I think, looking at some of the mainstream media out there, certainly a lot of conversations about the potential for an AI bubble. Many of you feel that we could be in a bubble currently. There are certainly other data points out there suggesting that risk factor, such as some of the massive spending and debt financing for semiconductors and other parts of the AI economy, such as data centers. So we'll see. Let's explore this topic in a bit more detail and with sort of the poll question in mind. Another way of looking at the potential for an AI bubble is to broaden out this conversation to what type of decision making tends to drive asset bubbles in general. One way to do that is to lean on behavioral finance. We could look at for a few red flags, again, that could lead to this bubble behavior, such as overconfidence in predicting future growth. Think about that with what's going on with AI. Recency bias, are investors ignoring historical asset bubbles in fear of missing out, or FOMO, where investors overvalue the upside case and underappreciate the downside risks. So if any of this sounds familiar, this could be something that we're seeing a little bit of currently. Some of these factors that could be driving some irrational AI investments that could be on the build out side, could be on the sort of stock investment side. It is also important to consider a few more favorable scenarios where we could be in the early stages of an AI sort of part of the economy really driving a faster growth. So let's compare AI to a few historical precedents that's seen on the next slide. So many bullish investors believe we could be in the early innings of another tech revolution. And this time, AI tools could allow workers to do more with less. We could see a surge in productivity, and that could be driving significant economic growth. We have seen that in other economic cycles, or technology cycles, rather. We see the printing press, the light bulb, or even the iPhone. So again, these are some things that investors are grappling with as we think about what's happening right now with AI and what's next. Next slide, please. Don't worry, there won't be a quiz at the end based on this busy slide, but we do believe that it's important to follow the money as we're thinking about AI and evaluating risks of a potential AI bubble and that bubble popping. This slide shows what some are calling circular finance. For example, company A gives money to company B, who turns around and uses that money to buy company A's products. So you can start to see there could be some risk involved in this kind of back and forth. This type of arrangement is perfectly legal. Some companies have done this for years. You can even look at something at the consumer level, such as an auto dealer offering a car loan to buy a car. However, on kind of one hand, this type of complex financing could be speeding up the AI build out as companies race to become first in class or best in class. Again, some pros and cons here. With that in mind, let's turn to the next slide. While some may look at this circular financing as possibly a way to speed up the AI build out, there is an alternative case, and that could be where there's a slowdown. We could see some potential problems worsen quickly as some of this circular financing, some of these relationships unwind. Again, the idea of house of cards, I don't know if it would be that dramatic, but I think that's kind of the idea that the more you lever up some of these financing arrangements, that the reverse can happen quickly. With that, let's keep going as we evaluate some of the pros and cons of the AI boom and its impact on markets. Next slide, please. So there's been a lot of excitement around some of the growth with the AI boom, and I think within that, some investors are potentially worried about overly bullish expectations. However, we can use Microsoft as an example, and we can see that sentiment as measured by a price to earnings, or PE ratio, was actually much more optimistic during the dot-com boom compared to today. We can broaden this conversation out a bit more and look at a lot of other tech-related stocks, which are today trading at, you could argue, fairly reasonable levels, especially compared to tech stocks in past cycles. So AI stocks also, in our view, look fairly reasonable in some ways compared to bonds, which may be kind of a different argument. Folks might not talk about all that in the media a lot, but that is something that we've been evaluating as we think about AI. What are investments looking like, and how do those compare to other alternatives? Next slide, please. This chart shows the 10-year Treasury yield going back to the late 90s when yields were a bit more attractive. They were kind of around 9%, let's say, compared to today when the yields are in the low fours. In theory, when bond yields are higher, there's a higher opportunity cost for owning stocks. All else equal, that should pull down the value of stocks. Said differently, would you rather own a tech stock or a 6% bond? Bond sounds pretty good. Or ask the question differently. Would you rather own a tech stock or a 4% bond? In that case, maybe the tech stock's a better option. Using that math, lower bond yields now suggest that stocks should be worth a bit more, again, thinking of the alternatives in the bond market. However, as we just showed with the Microsoft chart, many tech stocks are now trading lower than they were in the dot-com boom. So a lot of moving parts in this analysis, but our bottom line is that the bond market, we think, is taking away a bit of the kind of bearish view that AI stocks are in a bubble. Next slide, please. Okay, so let's wrap up this debate on a possible AI bubble with some pros and cons. On the risk column in red, we have the complex vendor financing. We also have a track record of hype cycles that often tend to overshoot, and then you see a bubble pop. We also have some concerns over companies that are really focused and highly concentrated in this very specific area of AI data center build out. However, moving over to the right, more in the green column, we think that As we think about what could keep this momentum going, we could be in the early innings of this tech wave that really is driving some significant economic growth. We're also seeing some measures of investor sentiment that seem somewhat reasonable and below prior tech booms. We're also hearing from companies that they're struggling to build out data centers fast enough for AI. So still a lot of demand out there. So overall, we believe it's important to have some exposure to AI companies, but as active managers, we're constantly reevaluating downside risk and upside potential. Next slide, please. Okay, so we just wrapped up a discussion of the AI build-out. A lot of that is feeding into current economic growth. If we broaden out that discussion to turn to another question that we're hearing from a lot of clients, that question is, what happens if there is a broader economic slowdown? Before we explore this topic further, let's turn to our next poll question and get your sense of what's next for the economy. Mike?
Yeah, so the two questions have been, AI in a bubble, and the other is, what about a recession? And what's the likelihood of a recession in 2026? So, for our attendees, the poll question is: do you think the U.S. economy will be in a recession during 2026? There are three options here: yes, no, or option C is we are already in a recession. So go ahead and check whichever. I guess it's a circle, not a box, Mike. You think is most likely to apply here, please. All right, so we've got a fairly optimistic crew here, Mike. So will the economy be in this recession in 2026? More than half, 56%, say no, and yes, or we're already in a recession is 44%. So 55-45. I guess when you add them up that way, fairly evenly split.
Yeah, absolutely. So good to get the feedback here. I appreciate the optimism. I also hope that the economy keeps growing next year and we avoid recession. I think in terms of the majority view from the poll question, I do think that is more of a mainstream view. Especially one thing we can look at is the Federal Reserve. Last week they met, put out projections for the economy for next year. They are anticipating steady growth, so they do see fairly low odds of recession. Certainly touching on the other options, could there be a recession? It's a possibility. We're seeing a weakening job market. We're seeing some slightly hot inflation. Some voted for we're already in a recession. That certainly it could be a possibility. I think probably a little bit lower odds of that. But I think you could argue that some parts of the economy might already be in a recession. I know there's a discussion about a K-shaped recovery or growth where middle or upper income segments tend to be doing okay, but that the lower segment is really struggling and it could be in a recession. So a lot of things certainly happening here as we look at what's next for next year. In thinking in terms of what could tip the economy into recession, our sense is, base case, stable but slightly hot inflation may continue to add a little bit of pressure. We do see some additional worsening in the job market. Both of those factors may weigh somewhat on economic growth. However, we fall back on the Federal Reserve, and the New York Fed, I think, does a good job of looking at recession predictions. We see fairly low odds of that happening. So to be fair, there could be some external supply or demand shocks that change this picture on economic growth next year. However, as we evaluate both upside and downside risks to the economy, let's switch gears a little bit and look at what could be more favorable. Next slide, please. So if we think about what's driving a mainstream view of kind of steady economic growth next year, there's a few things that sort of build up to that. Some analysts, going back to our conversation on AI, suggest that AI tools could already be sort of helping workers become more productive. That certainly helps out the economy. Separately, politicians and policies have lowered taxes and interest rates. That's most likely heading into next year. I do think that's something that can keep the economy going. And staying with policy, as we look ahead to midterm elections next year, many experts suggest that we're likely to see fewer significant policy changes in 26 as candidates focus more on messaging and campaigning. So a few different moving parts there in terms of the pros and cons, but I think having outlined both bullish and bearish views on the economy, let's now turn to our market outlook. Next slide, please. So before we look ahead at 26, let's take a quick look back at really an impressive run we've seen for large cap US stocks. This is taking kind of a 10-year period, we're seeing roughly a 15% total compound return year after year, including dividends over the prior decade. That includes some significant challenges such as COVID in 2020, and even last year when some of the Liberation Day tariffs really drove a lot of market volatility. So again, this is sort of the framework we're coming from, a really, really hot period of returns. If you compare that to even further back in history, it's definitely more attractive. I think throughout history, generally, you usually are seeing stocks up about high single digit, 9, 10, maybe 11% per year. Let's turn to the next slide, please. So as we think about how stocks will perform in 26, we can start with a focus on corporate earnings growth, with the idea that stocks generally chase earnings. Specifically, analysts are looking for about 13% profit growth next year, although many times we do see a bit of an optimistic number in the beginning of the year, and that starts to fade or take a bit of a haircut as we proceed through the year. Companies have to execute on that. Additionally, we can look at current sentiment and market valuations as a rough gauge of how stocks will perform. Investors are relatively bullish already, and with that in mind, it may be difficult to expect valuations to improve further. In fact, there could be a bit of downside. So putting these factors together, we could see, for example, high single-digit earnings growth, or sort of low double-digit, perhaps a bit of a modest decline in investor sentiment, getting somewhere to mid or perhaps high single-digit growth for stocks. That would be relatively close to, again, that long-term average, maybe a hair under, but could be potentially a little bit less than what we've seen in the prior decade. However, other things such as economic growth, changes in what's going on in AI, elections, as well as Fed policy could all feed back into what's going on with the economy, with earnings, as well as with stocks next year. So with that, let's turn to our positioning on the next slide. We just laid out a case for generally modest stock market performance next year. And within that, we generally favor the U.S. market, where we're seeing earnings grow faster. However, that growth comes with a higher price tag. We're also keeping some exposure to non-U.S. markets, which generally are seeing growth a little bit slower than in the U.S., but they're trading at a discount. So we do like that diversification. With that as a quick update on the equity outlook, let's turn to our views of the bond market on the next slide. So we showed earlier that high-quality bonds are offering right around 4% yields. And this is a 10-year treasury. That's generally above inflation, although as we think about what's next for the bond market, we could see some additional easing from the Federal Reserve as far as rate cuts. This could pull some bond yields lower, especially for bonds that mature in less than 10 years. With company earnings continuing to grow, we do continue to favor corporate bonds, and we like the credit there. However, one thing that we are taking a hard look at is the additional yield you're getting for the slightly higher risk with corporate bonds versus treasuries. We call that a spread, the difference in yields. That spread has tightened somewhat. That does reduce a bit of the attractiveness of corporate bonds. However, we do still like corporates because they're offering you generally fairly low risk and slightly higher returns relative to treasuries. Next slide, please. So with that, overall, in terms of bond positioning, we still favor high-quality bonds. We think you can still beat inflation. We prefer to spread out our bond maturities in case we do see some declines in short-term interest rates. And with that in mind, let's turn to our final poll question as we look at markets in 2026. Mike?
Thanks, Mike. Katie, yeah, there we go. So question back to the audience. Which asset class do you think will have the best return in 2026? Treasury bills, right now yielding around 3.5%. U.S. equities, international equities, gold and or precious metals, or Bitcoin and cryptocurrencies. And I realize that I'm bucketing some things together there in the last two options. Go ahead and take a second and fill that out, and then we'll get through to some Q&A here. Wow. All right. We call that in the CFA world some good old-fashioned home bias, Mike. I like it though. 80% plus say U.S. equities. Nobody chose the T-bills, which would be the nervous answer. And then international equities and Bitcoin were tied for second at 7% each. So good stuff. All right, thank you, Katie, for sharing that.
Right.
Um, yeah, there you go, Mike.
Excellent. So good, good, great feedback, and we can maybe jump into some of these asset classes in the Q&A. But certainly in terms of the U.S., it has underperformed this year relative to international. It's underperformed also versus gold. So there certainly is a case for a reversal next year for the U.S. to go back to outperforming. So we can certainly get into that. As we wrap up on our conclusion on slide 18. So looking ahead, Katie, if we can go ahead one, perfect. We do see a reasonable chance that the economy keeps growing, though we will be watching for any signs of a recession. While many are asking if we are in an AI bubble, we do see additional growth ahead, although we are keeping close tabs on demand, financing arrangements, and investor sentiment. Overall, we continue to own stocks and bonds where the companies are growing and gaining market share. Again, looking for higher quality companies that are out there. We prefer to be fully invested. We really try to avoid any type of market timing where you have to make two really smart decisions, getting out and getting back in at the right time. So with that, thanks for listening to our prepared comments, and let's turn to your questions, Mike.
Very good, Mike. Yeah, as I said, we've got about uh, a dozen or so individuals have sent some questions, and some of these overlap. As a reminder to those who are on the call live here, at the bottom of your toolbar there's a series of buttons or icons. The Q&A icon says Q&A, and it's got a box and a question mark. So let's go ahead while you're filling in real time some questions. We'll get into some of the questions that were asked in advance. Before I do that, just one quick moment on the that last poll question. I think Mike gave the order of the first three, but I think it's worth a minute just as we're sitting here 2 weeks to the end of the year as to what that looks like 2025 year to date. So of those asset classes that were listed, gold, not even close, is the outperformer in 2025, up 60% plus in terms of price per troy ounce this year. Next is international equities, as Mike mentioned, dollar weakness and valuation gap arguably there. Then U.S. equities. So U.S. equities didn't outperform international or gold. It did outperform both treasury bills, which would be next, also a positive return. The only negative return of those five asset classes year to date, at least through last night, was Bitcoin. So there you go. Okay, so let's dig into. I've got a couple questions here on bonds, Mike. Let's see. So I'm going to combine these. Hearing a lot about 26 being another strong year for bonds. Can you comment? And I'm going to tie it in with, can you explain why the 10-year yields are increasing or staying the same when the Federal Reserve is actually lowering short-term rates?
Absolutely, yeah, we can dive into that. Certainly, a couple things as far as what's going on with the bond market, the yield curve, et cetera. So one just sort of thing to start out with, the Fed has more control over the front end, sort of the very short-term rates, the federal funds rate. That's something that they control through policy. They do not control the rest of the yield curve. So that is up to the market, buyers and sellers out there. Historically, you do generally see movement there, somewhat similar to what the Fed's doing, but certainly not locked together. So one thing that folks are talking about looking out into the 10 years, for example, growth and inflation. If you believe that the economy, if there's economic growth out there and or inflation could be a little bit elevated. Inflation's around 3% now. The Fed would like it to be lower, around 2%. So if either of those numbers, growth or inflation, is a little bit higher, longer term bond yields may also stay somewhat elevated. So there are a few different wrinkles out there, but again, those can move. And so looking into next year, we could see some additional Fed rate cuts at the front end, and we'll see what type of impact that has on the long end around the 10 year as well.
Very good. Let's see here. Sorry, gang, just Yeah, there's a few questions that tie back into the AI bubble point, and I think we covered that in terms of the pros and the cons. Mike, maybe just to clarify on some of the circularity of some of the deals, which is that really kind of confusing slide toward the front of all of the money moving back and forth. Would you mind just spending a minute on in terms of how one company's, and you also use the term leverage. So I just want to clarify on that. So let's talk about like one company's cash flow, i.e., like Microsoft, or, and I'm going to give you a couple companies, that the hyperscalers, Microsoft or Alphabet, Google, their cash flow, and then that cash flow being another company's revenue, such as like an Nvidia. So let's talk about that versus some of the investing in the differential there, and how they're funding that versus debt.
Absolutely. So yeah, a lot going on there, and this goes back to that one slide, I think number 6 that we showed earlier. So a few different things. One is, I mentioned kind of vendor financing. This could be a case, like I said, company A gives money to company B takes that money, comes back and buys a product from company A. It's legal, again, it's out there. That's one kind of story. The other piece I think that Mike, you mentioned, is leverage. This is borrowing. So let's say you're OpenAI, you're creating kind of this search engine ChatGPT. You need money to keep growing. You want to build out data centers. You really want to sort of be first in class or best in class. You don't have the money today to do that, so you're borrowing money. That's leverage. So if there's a problem, you owe that money back, and that could really lead to some issues going back to the Great Recession, 2008 and 9. That was really something that just absolutely magnified the problem. You had banks that were borrowing to the tune of 20, 30, 50 times. So, a problem that would, where you'd lose $100, you'd have to multiply that times 50x to know your real liability. We are starting to see some of these big tech companies borrow and use leverage. Again, that's something where it magnifies the upside. If you borrow today, build today, and become first in class, that's great. However, if that doesn't happen, if there's a slowdown, you still have to pay back that money, and that can really lead to some additional problems down the road. So those are some things that we're evaluating at this point.
Very good. Thanks, Mike. Okay. We've got a question here about true underlying growth rate, and is it sustainable? I don't know the entirety of that, but I'll give you a variation of it. I mean, maybe we talked about this a little bit in investment committee yesterday or today in terms of the underlying growth rate of earning. Let's just go with earnings growth as a proxy. And we'll talk about GDP in a minute, but earnings growth for like the Mag 7 versus the other 493, and what that's looking like coming in for 25 versus what the forecast is for 26.
Yeah, great question. So, this goes back to one of the slides where we were looking at, what could stocks do in calendar 26? One way to look at that is how fast are profits growing. That's kind of an indicator if stocks are going to chase that. The simplest equation would be if profits are going up 13% next year, stocks might also go up 13%. It's never that kind of black and white, but that's kind of direction that we're looking at. To kind of break that down further, within that 13% growth, first of all, that's just an estimate. A lot of Wall Street analysts come up with that number. There are 500 companies in the S&P 500, so there's a lot happening under the hood. However, some of the big tech mega caps, they are driving a disproportionate amount of that earnings growth. It's well above 13%. Other companies, the people talk about the Magnificent Seven. There's the other 493. Earnings growth a little bit slower for some of those companies. So it's a little bit difficult to really completely tease out, what is AI. There are a few companies such as NVIDIA. Really, the majority of what they're doing is focused on AI. So you could pull out a company like that, but a lot of other companies are doing multiple things. So it's a little tricky to really say exactly if you removed AI, what's the rest of the market growing at? It would most likely be less than 13%. So certainly there is there's a benefit there. And we're going to have to keep an eye on it as we go through the year, quarter by quarter. Companies are going to be giving projections. We'll have a sense of, is the AI boom still going? Are tech earnings growing faster than the rest of the market? And how's the other 493? Are they still doing well? Is anything slowing them down? So those are some of the different factors we'll be keeping an eye on as we get into next year.
Yeah, just for those at home, I think the 25 numbers, the rough rate for the 493 is 8 to 9%, and the other seven is 22. So it was just so you get an idea of the factor here. So two and a half times. And then of course when it comes to the index, the weighting of those companies that are growing at the 22%, and because it's a cap weighted or capitalization weighted index are greater, and so that's where you get some of that skew. Very good. Combination here. We didn't really talk about tariffs in 26, and within the context of the tariffs and other pressures, just inflation outlook in 26. So I'm throwing tariffs as an inflationary thing. Um, do you think things, are sticky, or do we think things are sticky to where they are in the mid twos to three, or trending down towards two, or potentially going higher?
Yeah, good question. I think the whole issue of inflation was a really hot topic going back to coming out of COVID and calendar 22 and 23. I think we got to 9% consumer price index in terms of inflation. It's come down a lot. It's around 3%, but that's still again above what the Fed's looking for. The question is, what's in that? Are tariffs part of that 3%, which is running a little hotter than the Fed would want, or not? So I think that's something we're looking at. Our sense, and there's definitely a lot of moving parts, is that if you were to go back and there was tariffs in 25 or the exact same as 24, you probably would have slightly lower inflation. It's a little tough to exactly kind of tease that out, but it's in there. There are kind of two different camps for what might happen next year. Some more cautious investors worry that in calendar 25, a lot of companies kind of papered over and tried to figure out a way around tariffs, but they're really going to kick in 26. That would be a big negative. Alternatively, other more bullish investors say, tariffs are out there. Companies are highly adaptable. They're changing supply chains, and they're able to kind of manage through some of these big tariffs. So a couple of different things to be thinking about. We will get another update on the consumer price index. I believe it comes out tomorrow. So we've seen a lot of delays of the government shutdown. So these are some things that investors are going to be watching heading into next year.
Thanks, Mike. Anonymous attendee one would like to know. So if the other seven pulled out, what's the S&P growth? I think I answered that. The number for the current year is on the EPS growth is 8 to 9%. So the growth doesn't necessarily, equate to the actual growth in the indices. So just keep that in mind. You can have a positive growth rate, negative market, or vice versa. So I think we answered that question. Okay. I'll take this one. Chris says, any thoughts regarding investing in small nuclear energy source companies co-located near data centers to serve the AI energy needs of ostensibly of said data centers? Chris, I've made commentary on some of the some of the financial news networks on stuff like this. I would consider these lottery ticket type investments. You're not going to see us investing in nuclear companies close to data centers, particularly when the nuclear isn't already constructed. There are plenty of these companies out there, and you've seen probably some of these really small micro cap share prices, up 3, 4, 5-fold over the course of the last 12 months. If you know nuclear, it's not cheap and it's not fast. The share prices have probably factored a lot of that in, so not something we would invest in. Okay. Let's see. 1 second. Got another one here. So rationale behind bonds, if the only positive is that they beat inflation. So Mike, you want to talk just about the portfolio aspect of that, and then I have something to add.
Yeah, absolutely. It's a good question. I think if investors are seeing stocks do great over the prior decade and seeing stocks doing kind of more pedestrian type of performance, you might say, why would you ever want bonds, in a portfolio, if the only reason is to beat inflation? So that is a reason. I think inflation's out there, can't really control it. I think you want some of your assets to at least beat that. However, some would argue that bonds are a type of sort of portfolio insurance, if you will, for the equity side. So, for example, we've talked about, could AI be a bubble? Could there be a recession? Something like either one of those happens, I would expect a downturn in equities. If you have a significant amount of bonds in your portfolio, yes, they're offsetting inflation. That's fine, but that's a way for you to get back into kind of rebalance back into equities, take advantage of those declines in equity prices to get back to a balanced portfolio. Ideally, equities bounce back, you perform well, and you can push back towards bonds, and that insurance is still there. So, really, it is an important part of portfolios for many folks, and it's helpful that the return is above inflation, but really there's certainly a lot more to it than that.
Yeah, and of course, the only thing that I would add is that returns are the variance above inflation does matter. And some periods of time, that's 1%, as Mike mentioned, with 10-year Treasury right now, it's about 1%, 100 basis points or so above inflation. Corporate bonds are closer to 1.5 or 2. And if you look at bonds total return for the year, the return above inflation is closer to a real return of 3% plus. That is attractive. A 3% plus real return is over the long term what a balanced portfolio has done over inflation. So if your safer part, your lower risk part of your portfolio is giving you an opportunity for that higher real return, most clients, most investors should take that to some degree with part of their portfolio. There's a big difference in buying bonds with the 10-year at 4% than when it was below 1% in 2021 for sure. Okay. Let's see. Let's stick with rates and bonds for a minute. Brian says, where do you expect terminal policy rate and long end yields to stabilize by 2026? What's your outlook for the yield curve? Maybe I'll start on that, Mike. Again, we just have been discussing this over the last couple of weeks with the most recent rate cut. The the race for the 3 or 4 horse race to become the next Federal Reserve governor, which will be different from where we are today for the first time in 8 years. Next holiday season, we will have a different chair of the Federal Reserve Board. That chair is the president's job to appoint. And the few front runners there have pretty much all indicated that they think that rates today need to be lower. So the current rate regime is around 3.5%, 3.5 to 3.75. If you look at the economic outlook in terms of like what the Federal Reserve Board comes out with, the expectation is 1 or 2 more cuts next year. I think with the generally consensus around 1. I would say yes to 1 and likely to 2, assuming nothing crazy on the inflationary side, because that's where they seem to want to take rates is lower. There is concern on the lower rate crowd about the growth of jobs in the U.S. Before we stopped getting data in October, we had 4 consecutive months there of less than 30,000 jobs added a month. We've got some numbers released since better than expected, but we've generally had trend of negative revisions. And so if jobs are a concern and rates are a tool, then you can expect some lower term rates. The reason that longer term rates again aren't moving is because there's still inflation hasn't been moving down in check with rates going down. It's been sticky between 2.5 and 3. And that would really kind of create a bit of a conundrum if they're in a rate cutting cycle and then all of a sudden inflation does tick back up. But you should get some wind at the back of inflation if the job picture remains tepid or weakening. If it's going the other way, then some of the concern today about jobs is probably less warranted, and then they pivot to the being more concerned about inflation. So 4% feels about right on the 10-year, plus or minus 50 basis points right now, I would say. And over the course of the next few quarters. Of course, if there's some type of a outside exogenous catalysts, or that leads into a really drastic rate cutting, all bets are off, and you would expect to see people buying bonds, which naturally lowers rates. And so that's what's remember, it's the markets that's determining the long rate. Mike, anything to add, or you good?
I think you covered most of it. The only, kind of relative minor wrinkle that's out there, we talked about inflation and tariffs. So tariffs are probably pushing inflation up a little bit, which is also maybe keeping bond yields up a few years out. There's a Supreme Court case related to tariffs. So, perhaps if that goes in a particular way and tariffs go back to kind of 2025 levels, maybe inflation comes down. I mean, does that have an impact on the bond market? So there's a lot of other factors out there like that. That's certainly something we'll be watching as it impacts, Fed activity as well as interest rates.
All right, there's a couple of questions here that I'm going to combine, Mike, around. Yeah, I'll keep it on the macro side. Macro risks, bigger macroeconomic risks that are worth losing sleep over, that could potentially, contain some asymmetric movement in the markets. Anything kind of front of mind there? What's going on geopolitically, et cetera?
Yeah, no, great question. Yeah, I think a lot of times it's the unexpected risk factor that really drives things. And no one expected a pandemic. COVID came, markets went one way, and then they came back. Certainly there are other examples of things that just investors aren't anticipating. Based on what we can see now, certainly job market inflation, Fed activity, those are kind of within the realm of what people are talking about. What else could happen? We certainly had a scare this past summer in terms of some bombing in Iran. Markets were volatile for a short amount of time. There was a short impact on commodity markets and energy. There could be something else there, whether it's with Russia, Ukraine, Venezuela, certainly some other things. If that has an impact, again, on energy prices, does that have an impact on inflation and what the Fed's doing? So there's certainly a lot of different things that could feed back into what we're evaluating here as a base case. But at the moment, I think really the main variables to think about are the job market, what's going on there, inflation, and how do policymakers respond to changes there.
Good. Cynthia asks, being told the stock bull market is going to end. Of course, at some point it will. Is this one different? The answer is no. This time is never different. What should investors do to prepare for a correction, and how should they think about taking advantage of gains? This is a really good question, not just about in terms of like where are we in the cycle, but I think that because of some of the concentration of some of the growth that we talked about within the AI sector, a lot of these names are names that FBB clients have. Trimming things that have gotten out of and kind of an outsized position mode within accounts, and including names that have done really well historically, but have maybe are not keeping up or not growing as fast as they once were, and being open to closing out those positions, even when you have capital gains attached to them. We would highly, what we lean on is rebalancing. And I would say clients' expectations around rebalancing, the capital gains that might generate in a given calendar year, that needs to continue to be something that you talk with your portfolio manager about during your meetings, because we need to occasionally clear the decks of things that have done well but maybe aren't going to do as well in the future for whatever reason, and or trimming some things that have done well, but position sizes have gotten a little bit out of whack, and using those proceeds to buy other assets. And that means for a lot of clients, rethinking about what acceptable gains numbers are. And just to put that in context, we're very kind of anchored to thinking about capital gains in dollar terms, because that's how it impacts us in terms of taxes, how it comes on the front of our 1040. We need to be a little bit more, seeing the periphery a little bit more, the bigger picture, and thinking of gains in terms of a percentage of, the portfolio or invested assets. And so you could have 3 to 5% capital gain, and have high 5 to 6 digit kind of absolute number, that should be reasonable with the right planning and expectations. All right. I think we are good. We covered most of it. Thank you all for your participation. Um, we wish you all a very wonderful holiday season. We thank you for your continued trust and confidence in the team here at FBB, and wishing everybody a safe, happy, healthy holiday and new year. And looking forward to seeing you in 2026. Thank you very much.
Thank you.